final episode, the last 5 scenarios, the volatility tapes, including the one that has ended entire careers, and then the process that ties all 8 episodes into something you can run every single day. Episode 8, the final playbook and the process. Scenario 11, term structure inverts before an event. 10 days ahead of a major decision, front expiry IV rises above the back months. Backwardation, with a visible kink right at the event date. Skew steepens. The spot market, meanwhile, is calm. What's happening? The options market is pricing a discrete dated storm. Institutions paying premium prices specifically for event coverage. The fear is in the insurance market, not yet in the tape. Reaction. Extract the market's own forecast. The IV gap around the event tells you the implied move. Position so an in-range outcome doesn't hurt you. Avoid buying front expiry options. Peak price, instant crush after. Hedge in expiries beyond the event. And remember the Vanna asymmetry. No disaster means crush, means mechanical rally. Invalidation. Backwardation deepening after the event passed. That's not calendar pricing anymore. That's genuine present stress, a much more dangerous regime. The trap. Reading pre-event backwardation as smart money knows something terrible. Usually it prices the uncertainty, not the outcome. The base case is the kink collapses and the Vanna rally runs. Scenario 12. Realized crosses above implied, the breakout alarm. After a long compression, daily ranges quietly expand until realized vol crosses above implied. Options, remarkably, haven't repriced. Insurance is now cheaper than the storm already happening. What's happening? The vol market is behind the tape. Premium sellers, conditioned by months of easy decay income, are still offering options at yesterday's prices. That mispricing doesn't last. Either the tape calms or IV chases it up. Reaction. This is the regime change alarm. Favor owning options over selling them. Favor momentum over mean reversion. If you're short premium from the calm regime, cut or hedge. The income trade's edge just inverted. Cross-check gamma. RV hot plus negative gamma is full breakout physics. Respect trends completely. Invalidation. The cross was one stale gap day rolling through the calculation window rather than genuinely expanding daily ranges. Check whether recent days are actually moving. The trap. Continuing to sell rich-looking premium because IV is up from its lows. IV up but still below realized is still cheap. Rich or cheap only means something against what's realizing. Scenario 13. Calm surface screaming sector. The broad market VIX sits benign in the low teens, but the tech vol gauge runs 8-10 points hotter, and the mega cap single names carry elevated IV. Indexes hover near highs while tech chops violently underneath. What's happening? The options market is pricing sector-specific stress that the headline VIX hides. Hedging demand is concentrated in the leadership. Institutions ensuring the crowded trade, not the market. A loaded spring. If the stress spreads, the calm broad pricing is wrong and repriced fast. Reaction. Read the right vol index for what you trade. A NASDAQ trader taking signals from VIX is reading the wrong instrument's insurance price, and the expected move math must use the hotter number. The divergence itself is the warning. Either the sector calms and it closes benignly, or contagion spreads and broad market hedges are underpriced while it lasts. Invalidation, the divergence closing from the top, sector vol falling to meet VIX, stress resolving. The trap. VIX is low, market's fine. VIX is one index's insurance price, not the market's health certificate. In concentration eras, the sector divergence is the tell that matters. Scenario 14. The Friday magnet, expiry day. A strike just above holds enormous open interest built over weeks. From mid-morning, the index grinds toward it and stops, orbits it. Every 15-point deviation snaps back, closes nearly on top of it. What's happening? Pin risk at maximum, dealer long gamma at the strike peaks on expiry day, and their hedging fades every departure. Reaction. Respect the magnet from late morning on. Fade small deviations back to the pin. Small and quick, and don't initiate breakout trades against its gravity in the afternoon. Holding short-dated long options near the pin, your extrinsic value is being ground to zero exactly where price is stuck. The magnet is the premium seller's payday. Invalidation, a genuine catalyst mid-pin, news outranks gamma, or a late break on real volume. Rare, but late pin breaks tend to run as the trapped hedges unwind directionally. The trap, expecting the pin to matter Monday, Saturday morning that open interest ceases to exist. The magnet is a one-day phenomenon. Scenario 15. The crowded short vol unwind. The career ender. Months of calm grind higher. IV at multi-year lows. Selling premium has worked so long it's become the crowd's income strategy, sized up on every dip. Skew flat. Nobody pays for crash protection. Then a modest 2% down day arrives, even accelerates into something historic. What's happening? The short vol trade became the crowd. The move exceeded the calm regime's ranges, and short vol positions hit stop losses and margin thresholds simultaneously. Their forced covering buys vol and sells the underlying, which pushes vol higher and price lower, which forces the next tier. A reflexive spiral where position covering, not information, drives the move when dealer negative gamma amplifies every leg. Reaction. You cannot time the trigger, but you can see the fragility. Record low IV plus saturated premium selling plus flat skew plus a years-long calm means cheap convexity, far out of the money protection, is at its cyclical best exactly when it feels most wasteful. Once the unwind ignites, stand aside or trade with it. Never catch the knife on day one. Reflexive unwinds overshoot every reasonable target. The trap, it always bounces. The regime that taught everyone to buy the dip is the same regime that loaded the spring. The strategy that worked longest with the least volatility is the one whose unwind is most violent. That's the playbook. Now the process, 6 questions, in order, before every trade. 1. What's the gamma regime and where's the flip? 2. Where are the walls and which expiry do they live in? 3. What does the vol market say? Expected move, rich or cheap, skew, term structure. 4. What does the calendar say? Days to OPEX, event kinks, what expires before my trade resolves? 5. What's the positioning? Extremes, fresh flow, who's on which side? 6. What invalidates me? Decided before entry, not during the drawdown. And the 10 commandments. Dealers have inventory, not opinions. Never quote a level without its expiry. Negative gamma predicts magnitude, not direction. Every wall is a hypothesis. Price is the verdict. The signal lives at the extremes. Only opening flow counts. IV is a price. Compare it to realized. The calendar is a force. Confluence is a trade. Contradiction is a warning. And decide your invalidation before entry. The market pays traders who know when they're wrong faster than traders who are right. That's the course. The machine, the map, the surface, the calendar, the footprints, and 15 tapes worth of practice reading them. The options market stops being noise the day you start reading the inventory behind it. Trade the flows, not the narratives. Thanks for being here, and I'll see you in the market.